Good morning, United Kingdom. Good morning, and we have no Lakhi Singh available, which is good. We don't have to listen to him because we know he's busy fixing people's properties and businesses.
This is Lakhi Singh, the fixer. Yeah.
Morning, Lakhi Singh, the property fixer. We were just talking about you, that you're not on, and we're having to continue without you, but we know you're busy. You're a bit like a superhero, like Spider-Man and like Superman, wearing your tights and your red boxers, saving people from their properties and their business problems. So the saying of this week obviously being, invest in yourself, grind now, or grind now, or grund now, depending on where you are in the world, and sit back and relax and enjoy yourself. The question is, can you still become a millionaire in property in these difficult times? Second question, obviously. So, Lakhi Singh, invest in yourself. What does that mean? How do you invest in yourself? Or invest in the future in yourself? Or invest in yourself into the future? Or invest the future into yourself and then grind? Grind now.
The only way to actually invest in yourself is to improve your knowledge, improve your health, improve your ability to take action, improve your access to a power team, improve your access to a network or a community like ours, the Alternative Property Business Solutions community.
By the way, we're just under 900 apparently, and I think we're growing fast. So we're going to potentially announce tomorrow, I think maybe, or by Friday, the special gift or celebration for the 1,000th member. So at the moment, we're just under 900, so we're growing obviously rapidly every day, every week, just to let you know.
Yeah, I'm acutely aware of it because I check it about every half an hour, and I usually invite quite a lot of people every day.
Wow, so your hard fixer work, being you're a superhero in your superhero powers, able to attract people towards the alternative business and property solutions community. We are but mere mortals in front of you, sir. So yes, continue.
So I think your investment is very important now, from the point of view that if you're investing the wrong information or the wrong knowledge, then garbage in, garbage out is a type of thing I would say. So my biggest, you could sort of say, complaint, or my biggest issue at the moment is with the media and the way they're overplaying how good the market is. And my concern is for those that are involved in property who are possibly not really seeing the reality of it. And I'll give you a very simple example, and this is me being Lakhi Singh, the property fixer, looking at it from my own sort of thinking of what the type of work we do. So, for example, one of the things that we've had recently is a news report a couple of days ago that we've had almost, I think, like a 50% increase in the number of sales compared to a year ago, which you would think in a pandemic where there's a massive lockdown everywhere and there's like a huge sort of slowdown in the financial market, one would begin to wonder really how that's even happening. Mm-hmm. Now, I've got two statements to make about that. So number one is, yeah, you're definitely going to get a increase in sales for anybody who's got, like 50 or 100,000 pounds lying around or a couple of hundred to take advantage of the stamp duty. And everybody's thinking, anybody who's got that sort of money lying around, they're going to be buying a couple of assets to create their nest egg. So one would expect actually that you're going to get a lot more sales coming through, merely from the fact that you're getting a discount. And anybody that's, let's just say, a 9-to-5 person who can now, think, how do I make my money work for me? That looks like the easiest bait for them to take, because they're not necessarily looking at things from a long-term point of view. They're thinking about, how do I make my money work for me? And a lot of that money is possibly even from bounce back loans from people. So it's almost like a self-created bubble. So three key points really. Number one is, if you've got more sales happening below the 500,000 mark, you're going to get more sales than a year from now. So that stands to reason. Number two, if people have been given a lot of money, been chucked money at them while they're twiddling their thumbs, working out whether they can do something or not, they're going to try and do something productive. And a lot of people have gone out and bought a property because that's like a natural lure. So they've done that. And the third and the most fundamental point is, if you actually, and this is the calculation that I think someone needs to do, and I don't know whether anybody's done it, but if you calculate the value of sales that's occurred compared to a year ago, then I'm guessing the value of the sales is going to be 50% below, because any property that's in Fulham or Chelsea now, that was a £3 million unit, it's probably being sold for 2.5 million, or with at least 10 to 20% sort of fall, because the stamp duty still needs to be paid at that level. So who's making that calculation?
Okay, that's a wise lot of words there from Lakhi Singh. So question being, invest in yourself now, invest in the future, grind now, and enjoy yourself in the future. Now, what does that mean then in these times? Invest in yourself, invest in the future, or invest yourself into the future. What does that mean? So you've got to...
I'm not quite sure what exactly it is. So is it grind yourself
into
now?
The future. Yeah.
Grind yourself
now,
into the future.
Yeah, something like that. I'll have a check back with my technic team. Yes. So it is invest in the future, Mr. Singh. Invest in the future. Grind now and smile later. That's what it is. So it's saying,
okay,
invest.
So the way I'd interpret that now is pretty much what I said. You've got to be on your game now. You can't really be letting... So there's about... So I think the other topic for today is the top 5 strategies to be a millionaire in property investment. So they all sort of go hand in hand, which is that if you want to be successful in this market, you've got to now re-look at the whole market based upon current circumstances. So you can't be looking at the market as it was pre-COVID-19. You can't look at the market mid-COVID-19. You can't look at it post-COVID-19 either. You got to look at it from a very realistic point of view. And one of the things that's happening in the market on a daily basis now is that we've just had a client recently whose property's value is about $1 million, and the debt on the property was around 500, and he only wanted to take out about 250,000, which is up to 75% of loan to value. So he's been to 3 lenders, and each one has actually valued that property at about at the 900 mark. It's about 100k below. And the most astonishing thing is that they only want to lend him about 40,000-50,000 because they only want to do up to about 55% by the time you take in a lot of other fluctuations. Now, obviously, Lakhi Singh being the fixer, I found him a solution for getting him the money by simply sorting out a bounce back for him and also using some of his other assets in a clever way to provide to the bridging company without actually exposing him too much to the markets. And ultimately, he's been able to achieve his objective, achieving to finish some work off on the property. So I think anybody out there is to be very careful not to think that the market is as it was. So by investing into yourself now and creating a better future, that's what the objective is, then you've just got to consolidate where you are now, understand the parameters of the current market, decide whether you've got the the cash reserves and the ability to get into the market and still turn a profit. So it goes back to our conversations with Ninder Singh Johal, our VVIP, who comes every Friday on the show. You know, everybody out there, are you stress testing what's going on? And if you're not stress testing what's going on, you're going to be thinking that certain things are available to you. But the reality is that it's not, those tools certainly aren't there anymore, especially in bridging finance.
Hello? Oh, you're cracking up, Lakhi Singh. Can you hear me?
That's good. I'm good. It's the first time I'm cracking you up. That's good.
I think, yes. Okay. Right. Okay, so where is, which are those 5 key points to become a millionaire then? What are they? What are the principal ones?
So, number one is, if you want to be a millionaire in this market, is to just completely relook at your current strengths, weaknesses, opportunities, and threats to where you are as a property.
Are you saying, okay, if you're not into property already, then what do you do then? If you're talking about somebody who's seasoned, like a mover and a shaker like you, and you can't give that advice to someone who's trying to come into property, someone trying to start off and make money into property. So where do you draw the line with somebody who's at your level, someone who's just starting, someone's in the middle, just bought a couple of properties, wants to make those properties into 10 or 20 or 30. So what do you do?
So let me start from the beginning. So anybody starting off, it's very simple. You've really got to do your homework. You got to do all the basics that you would do in any market, really understand really what the angle is. So I think the assumption, if you're starting off, is that the market prices are falling, and we don't really know what the bottom of the market is yet. So the question is, if property prices fall by 75%, or they fall by 50% in the UK, and in London it may be not as bad as that. It may be 60% or 30% fall in about a year from now. And the question is, have you done your numbers to work out really whether you can come into the market and still turn a profit? So you're going to stress test any business model in terms of your acquisitions or your cash flow model. So you've got to look at really which model will work for you in this market. And whatever strategies that were being pitched in lots of training courses in the last 10 years or so, you to look at them to see really whether they're likely to work. So things like lease options, rent-to-rent, service accommodation, flipping properties, everybody, you should just do your homework on all these strategies anyway, just to sort of develop your understanding of the toolkits that are out there to make profit.
Yeah.
So if you haven't got any money at all to invest, but you want to make money in property, then you could actually look at doing things like rents, because that could potentially still work, because you're not having to put that much capital in, but you're taking on the property on a three-year lease from somebody, and if the landlord's got a 10-year fix on their property, they're not affected by interest rates. They can afford to continue giving the property. So I think you just have to do some extra homework to make sure that you don't get caught out.
You're moving too fast, Lakhi. You need to slow down. I want to get into property, and you're telling me about fixed rate and all this, and so much jargon going on my head. Tell me, what's the first point, the stepping point for someone like me who wants to get into property, got no clue about it, but I want to become a millionaire in property? Why
So number one, there's a lot
why
of
are you jumping ahead and confusing?
There's lots of free education online, and there's quite a few training companies which you can attend, like a training course for £500, £1,000. They'll tell you all the potential ways of accessing the market. So that's point one. Point two is that you need to sort of understand really what your financial capability is. So if you've got a good income, if you've got equity sitting in your assets, really how you can leverage them.
I haven't got any assets. I've got good income only. That's it. Just keep it simple. I don't have any assets. All I've got.
If you got a good income, then
right. So I've got a shout out before you give me the answer to those questions. I'll just give a shout out. We've got Sajal, Amar Ali, John Smith, Sonia, and anybody else? That's it. All giving us a big shout out this morning. So I'm trying to keep it basic, Lakhi. Talk to me as if I'm a first timer. Explain to me. I've just got a good income. I want to get into property. I want to make my portfolio. I want to take advantage of, and let's be frank about it. Let's call it a crash. Okay, there's going to be a crash. There's going to be some, major adjusting in the property market values. I want to take advantage of that. Now, what I've got is what's against me is I've got no experience in property. I've got a good income, which is in my favor, but I don't have cash money to buy a property, but I can put down a big deposit and probably buy my first property. And London is too expensive for me. Okay. But I can go outside of the city. I can go to Oxford or Reading or Swindon or to Wales or to the West Midlands. I can go out of London and I can buy, but I've got good income. So tell me, what's the step? Well, how do I do it? What do I do first, second, third?
So number one is educate yourself on the basics of property, how it works.
Where from? Where? I mean, you're saying that to me. I mean, there's so much information out there. You can be reading books and books. You never quite know when. So what is the kickoff?
Number one, second point is you need to understand how much deposits you need to purchase a property.
Okay, that makes sense. So I need to know what the market is offering at the moment in terms of mortgages, what the loan to value deposit makes. So if they're going to give me 80% mortgage or a 70% mortgage, what's better for me? Is it an 80% mortgage or a 70% mortgage?
Well, what's better for you is the cheapest rate at the highest amount of leverage. So if you can get an 80% mortgage, I think you can only get 75% anyway. So your simple model, if you're just getting started off, is that you should be looking at the rentals and the property value. If you can get...
Okay, so that's my first point. Okay, now you're making sense. So I see a property, I'm going to see the rental value and the market value. So where's the best place to check the market value?
basically the market values, you can check them on Zoopla, but they are just an indicator, because if the market's falling, you can't necessarily take their indicators now as given, because as far as I'm concerned, everything's overpriced by 20-30%.
Okay, so we know now that we can't rely upon what's on the website. So I'm going to look at the rental value. So what's the rental value I'm going to be looking at then? What's that then? Which one's more definite? Is it rental value or is it the value of the property?
I think the values of properties at the moment don't count for anything. I would actually not necessarily take them too seriously. I would take everything with a pinch of salt. So you really need to do your homework on the yield. So ideally, you want to purchase something where the
yield.
rental.
You said rental, and now you're talking about yield. What's yield? Is that like yeast? Like you put something into a field and you see how many plants are in the back? Pardon?
Yield is a typical formula for working out the percentage profit you're going to make from buying an asset.
This is a problem. I'll tell you what I've got. This is a problem we have when we're very new to property and we're trying to talk to experienced property investors or developers like yourself. You're jargoning us with multi-layered verbiage, different vocabulary, and I'm finding it difficult to join it all up, because in one aspect you're saying you need to check the market value, and I'm saying, okay, where do I get the market value? Oh, well, there's no real market value because the market is all fluent. Okay, so what do I say? What's more definite? Is it the rental value or the market? You say, well, rental, yeah, you're going to check the yield. So I'm thinking, right, what does yield mean? Is it rental? Is it yield? What is it? So can you stick to one terminology and explain to me how it is I, with a good income, don't have any properties, got no experience in buy-to-let or having purchased a property, how do I get into property? What's the strategy? I live in London and I can't afford London, it's too expensive. How do I get into property and what do I do? So first thing is, you said value, market value. I don't know what market value is. You're saying you can't find out because the market's fluid. So how do I establish market value? You're not telling me that. Then you've jumped over to rental value, and now you're using a terminology called yield. What's yield then? What's yield? What's rental value? What's yield? What's the difference?
Okay, so I've explained to you how to establish a value of an asset first, which is you could use Zoopla. But yeah, I can only tell you what it is. I can't sort of explain things in a different way, because this is the terminology that's used in the market. And if you don't understand it, then you're going to try to look it up at Wikipedia or Google. That's the way it is. But if you want me to explain every single thing, then it could be like a 3-4 hour discussion. But I'll try to keep it simple. So if you're starting out, you want to buy, let's just say, a simple buy-to-let, just to get an asset on your books so that you can turn a profit.
That's what I want to do. Yeah, that's what I want to do.
So very simple. Yeah, you're right. It's going to be difficult to buy something, let's just say, for £100,000 just as an example. What you ideally want to do is buy a property that's £100,000, let's just say, and that has a rental of at least £1,000 a month. And after costs, you're left with at least £600-700 in your pocket in profit. Mm-hmm. So if you can get a fixed rate mortgage and £75,000 debt on the property, you got a £25,000 deposit to put in. Wow. Then the bank would lend you £75,000, as long as the rent is more than £422 per month, is the rough calculation. And then if you're getting £1,000 rent per month, and it's in a good area, and even if COVID-19 hits hard, and if you've got a property somewhere that's remote and there's a huge lockdown, you may have a problem with rentals. So what you also need to have in this market, this is something a lot of people don't know, is that a lot of mortgage companies, they want you to have minimum 6 months of rent sitting in the bank as well, to make sure that if the properties do become empty, or the tenant's not paying you for 6 months, then they don't have a problem with you. So that's actually become a prerequisite now with a lot of mainstream buy-to-let lenders. So that's point 2. So the yield, basically the rental that you get compared to the value of the property, is called the yield. So if you've got £100,000,
you get compared to the value of the property.
if you've got £100,000 property and you're getting £1,000 rent, that works out to 10%. So that percentage is called the yield. Is it 12%?
Yeah.
Okay, well, 12% then. So if the yield was only 6%, then that would be £600. So basically, the point is that anybody that's sort of investing into property now, in the falling market, you should actually be looking at a better yield, because you should be able to pick up properties for a lower price. So the lower price that you buy the property at, the better yield you get. So ideally, that £100,000 property that you're buying, if you were getting, let's just say, £600 rent, which is 6% yield, I'd advise you possibly not to buy it, because not really making any major profit from it. But if you had the opportunity to buy £100,000 house now, this is where I would say the angle is on making money. If you could convert it into 2 maisonettes, say, and let's say it was making 600, but you had to spend £15,000 to convert it into 2 maisonettes, and then the yield could increase to, let's just say, 10% per asset. So that would make it about, let's just say, £950 or something per asset. So that yield, your yield sort of goes up to 18%.
Yeah, that's
a sort of angle, one simple angle that somebody getting started off could be looking at. You could be just looking at properties you can convert, flats you can convert into, let's say a 4-bed flat you can convert into 2 2-bed flats, or you could convert a house in a particular area where they've got houses of the similar type which have been converted into maisonettes, and that would potentially allow you to get the yield. And the fourth thing I would say is that because interest rates are very likely to fluctuate over the next year or two, they're likely to go up. So you're better to put yourself on a fixed rate, and that way then you can sustain your profit. So that's, I would say, a very simple startup model. So there's 2 aspects to it. Number 1, you want to buy the property for the lowest price. Number 2, you want to get the best yield possible on day 2. Well, point 2. Point 3 is that if there's potential to value add and increase the yield and increase the value of each asset, then that's point 3. So as individual assets, if you then value them, then let's just say they were £50,000, it was worth £100,000 as a house, you may find that as individual 2-bed flats upstairs and 2-bed flat downstairs, they value at £80,000 each. So automatically, by spending £15,000, you increase the yield, and the values of the assets, depending on the quality of your restructure of the properties and the refurb quality, you improve them to 160,000. And if you're clever at architecture and design, and you put all mod cons in there, and you landscape the garden, and let's just say put furniture in the house, and you may actually, one of the things you could do is you could actually sell one and keep one, and then that will actually help you to take some of your equity out. So if you could sell one for 80,000, then you could create 2 separate leases on the property. Then you could actually take enough equity out then to buy your next one. So if you've got the perfect cash flow model and like an acquisition model, and then you stick to it, this could be a very simple formula for you to build a multi-million-pound portfolio.
Okay, so I think I'm finding that you're giving lots of high-level numbers and figures. I mean, I'm not getting the nuts and bolts of how I'm going to do that. It sounds a bit like Sajal says, that you've got to do a lot of research. I think you've got to do a lot of market research. You've got to literally get your hands dirty, go and see the properties, ask around, like Sajal says. And we've got a new listener called Adria, who's been listening in. She's giving us a thumbs up. She's liking what she's hearing. I'm finding it very good. It feels scary, confusing in some respects for me to get into property and make millions out of it. It seems very daunting. Yet, I think for you, it sounds like water off a duck's back. So is it all to do with experience? Is that why you know what you're doing? And I'm finding it very frustrating or daunting to think about the below market value and rental income and yield and value add and all these things. Why can't I just buy a property that gives me money?
Unfortunately, it's not as easy all of that, because the government has actually made a lot of changes on tax. The government's actually put a lot of licensing models around HMOs and regulation around actually creating smaller rooms and assets. So you really got to treat it like a business. And if you just want to make money, then I would say, sorry, don't even think about getting involved in property, because you really got to be looking at it like a business. You can't be looking at it like a nest egg as it used to be many years ago, because there was a lot of it was a very speculative market. You could basically invest into it. But in this market, you can't afford to be speculative. You could probably get away with being speculative in early 2000s, where people bought 10 properties and the prices doubled over about 2 years. In this market, you've got to have your wits about you, and you've got to be looking at every penny. So if you haven't got that discipline, don't get involved. Yeah.
Okay, so we've done the SWOT. So the SWOT analysis we've done, even if I haven't got a property, I've done the SWOT analysis. What do I do next, and what's step 2?
Okay, so if you're starting off, then you could follow the formula I just mentioned. Let's just say you may find that your brother or another person who's got, let's just say, additional skills to you, because you've got a friend who's good at getting planning and architecture. If you've got somebody you can work with, what you could do is you could do first asset could be bought by you, second asset could be bought by them. That way you don't need as much knowledge and experience. You've got each other to back yourselves up. That's how I started off, actually. I started working with a couple of business partners, and one guy that I worked with was really good at due diligence, and I was very good at sourcing the deals. He was very good at he'd actually be looking at every single nook and cranny of the house to see it didn't have subsidence. I was very optimistic. He was very pessimistic. So you might find somebody who's a bit different from you. Otherwise, if both of you are huge optimists, you're going to end up buying lots of assets, where you may not have done the due diligence. So next step is really having your power team around you. So your tradesmen, your architect, your solicitors, your finance broker, your bridging company if you need it. Having that power team will allow you to have access to all the knowledge you need to be able to do your risk assessment on anything. Having a quantity surveyor, even having a friendly surveyor who can actually look at the property and probably give you an idea of really what's happening. And also deciding on your locality where you're going to target, where you think is a good market where you could buy assets.
Power teams, can you just pick these power teams up anywhere? They're like something you can find local shops. What do you mean by power team? It sounds a bit like the A team or the Power Rangers. Is it a bit like the Power Rangers? And they have Dr. Smurf and all that?
No, it's not like the Power Rangers at all. It's power team is just a term for having a team of experts that can actually help you with your complete supply chain from beginning to the end of the whole thing for your modeling of your business. So the beginning part is sourcing. So you need to get the right agent or sourcing agent and decide on the location. So you need certain web tools. So the power team for that is going to be an estate agent or a sourcing agent. Then the second part of the process is checking out doing your risk assessment. So it's going to be a surveyor, it's going to be an architect, it's going to be a builder. So these are three important components in terms of whether you want to buy it or not, because your build costs, one builder might say it's going to be a couple of £1,000. Other builder might say it's £15,000 because they may have a different angle on what they do and the quality of work. And then once you purchase the asset, getting a quantity surveyor or an architect if you're looking for planning to value add. Also during the pre-purchasing stage, by the way, also getting a good financial broker who knows how to actually find you the right type of finance and look at really whether you have actually got the ability to stretch yourself to be able to purchase something. And near the end of the process is having a good agent if you're looking to sell or to rent, and understanding the rental market right from the beginning. Then also you might want an interior designer who can help you to uplift the property if you're looking to sell. So all these type of people, they're going to be a critical part of your success. And obviously the better, one of the things I was very good at when I did quite a lot of property in North London, I was very good at sourcing builders. So I'd actually get all my work done for about 50% of the price. And I was also very good at talking to estate agents and finding deals and negotiating a very good deal for myself, and actually literally bought about 15 properties in the first year or so of actually starting off.
Okay.
So I
what's
think
the next
those
step then? What's the step after that? Okay. Step 3. What's next?
Step 3 is, I think, having a very good accountant and also doing your cash flow forecast and your numbers. If you've got a very good model that works, it's a bit like anything. If you can, in any business, if you can make a good margin, you're able to scale up. So if you've done one project successfully, you need to then start now scaling up into project 2, project 3, project 4, project 5, or just stop there, because you may just want to keep it really simple. You're looking for a small side income, just to keep it going while you're looking for your furloughed and you're looking for a new job or something. You're in between jobs because of what's happening with the pandemic. So it's a good way to potentially keep yourself occupied doing something and still using your cash and optimizing it. So I would say that that would the next step after that would be deciding whether you want to stop there just with one asset, and that's actually enough to keep you in good stead. You've got a extra £1,000 coming in per month, and that's enough to enough to actually satisfy your financial requirements. But if you, like you said, the top 5 strategies to make a multi-million-pound portfolio in the beginning, then question is going to be, how do you scale this model up? How is it workable? So you probably want to stress test it more, and you probably want to talk to people who would understand modeling around scaling up a business. So you'd probably approach an organization like us, because we deal with people with we don't really deal with that many startups, to be honest. 99% of our clients tend to maybe buy 20 to 50 properties a year, and they like scale, and they buy distressed properties. So we would then probably help you to model or structure really your acquisition strategy. We'd charge you a fee for that. And it'll also look at what the tax implications are. So tax is critical, accountant is critical. The numbers in terms of your forecast to scale up is critical. And then your purchasing and your financial requirements to scale up are also critical as well. So all those ingredients need to be in place to make the
fourth point then. What's the fourth point? So we move on from there and go on to the fourth. What's 4 on this ladder of success? How do you take it to the next level? What's point 4?
Okay, so once you've got that in place, you know what you're going to scale up. Then what you need to do is you're going to need to have potentially staff, or you're going to have to be good at your accounting and all your paperwork, to make sure that all your paperwork is in order. So hiring a bookkeeper, that's going to be important. Also having an accountant who actually keeps a check on what you're doing, because you need somebody who worries for you. Accountants tend to be natural worriers, and if you're not a worrier, you're not thinking about where the stress in your property portfolio is going to be. You need somebody who's, like I said, who's quite prudent and very clinical about the numbers. So then I'd say the major thing is then actually having access to deals. And this is where the type of thing we do is we actually have a lot of portfolios, and deals come to us. So sourcing at the right price is going to be critical to your success. Then also having an acquisition.
5 points. You've mentioned 4.
Yeah.
What is the 5th point, and what's number 5? What's the last point then?
I would say the critical one is going to be having access to funds or a formula that allows you to scale up. Because if you wanted to scale up quickly, if your acquisition strategy means that you're going to pump a lot of cash into something, you're literally going to end up with no cash reserves. So the 5th point is really having a business model which is financially tuned up to allow you to scale up. That would be my 5th point.
5th point. So you're saying these are the ladders or the secrets of becoming a millionaire in this market. And
that's right.
This general formula, can it be applicable at any level? Do you have to be a millionaire already to become like a larger, bigger businessman, or can you start from zero? Can anybody just with a good income start this model?
Yeah, I think you can easily become a zero to hero. That's not going to be, I think anybody can get involved in property. I think you just need to have the right plan, the right people, and the right mindset, and the right level of knowledge and experience. If you combine that, then you got the perfect storm.
Excellent. Okay. So you've got obviously these 5 principal models, and you've worked these before. Have you given advice to people for before and they've used it? Are you able to provide a holistic solution for other people who want to become successful like you using the 5 principles that you mentioned?
Well, to be honest with you, what happens is this all comes down to experience. I don't really make it my job to advise people on this level of planning, because it's far too basic. A lot of what I tend to do is working with people who are already in the midst of actually doing this work. So they're already they've already got £2-3 million worth of property. They're already buying, 2-3 assets a month, and they're scaling up to the next level. They're trying to scale up to maybe 5 million.
Okay, Sajal Patel's asking. Okay, Sajal Patel's asking you, can you help someone build this model and help them deliver it? I mean, I assume she's asking from a point of view from a person who wants to get into property. She's done a lot of theoretical work. She's done a lot of research, but she probably hasn't quite gotten her feet under the table. Can you help? Can you get someone like Sajal to at least first base?
I mean, I used to buy about 10 a month in auction myself, so I understand the modeling very, very well. And I'm sort of perfectly placed to help anybody, because if I've seen people with the model already, it can be very simple for us to help people. But I think the issue is that if somebody's starting off and they need help, we normally provide a free half an hour consultation anyway. But technically, whatever I've described in this interview is pretty much the discussion we would be having with them to try and understand all these things. So basically, this is actually almost like a free consultation about all the things that you need to consider. But the only difference would be is that if somebody did come to me, I would charge them a fee, because I don't really have 5 hours in a week to spend with somebody who's going to be asking for my time. But we're always happy to give half an hour, have a chat with somebody on Zoom, or in the office, to tell them really which direction to take where they are currently. And I think the advantage we've got is that because we're a one-stop shop, we also got access. We've got access to Bridgingfinance. We've got access to the brokers. We've got access to the power team. We've got access to the stock as well across the whole country. So we could probably bring a lot more to the table as more of a one-stop shop for them to facilitate the process as well. So we could possibly help them with the whole supply chain, but we'll need people that have got quite a lot of knowledge already, because it's going to be quite difficult to tell people a lot of basics. I mean, if they don't know what loan to value is, they don't know how buy-to-let mortgages work, they don't know how yield works, they don't know how to bring value to a property, and how to turn a profit, and how to work in a distressed market, then I wouldn't get involved in helping somebody like that, because they don't really have the basics. But I'm always willing to sort of help, and I do actually help a lot of people who want a lot of basic questions, but I don't really always have time to be able to talk to them, because I get about 40-50 calls every day, and I'm constantly on social media all day long, pretty much 24 hours. So there's only so much you can do in terms of helping people with the basics. So hopefully this is actually, this video probably be a very good basic platform, somebody who's basically starting off and just wants to know how they get their feet in the table in beginning with starting off in property. Okay,
so if we take the saying, invest in the future, and we say, right, someone like me who's got nothing in the pot, no future in, can't see any future in property, how will I invest into the future? What do I do? Do I put money into property that I think is going to grow in capital value. Is that what the meaning says? Is that what the saying alludes to? Invest in my future. Should I do that? What do I do? Or do I invest in technology or something? Do I put my money into technology and expect to get the returns from there? Bitcoin.
So I think what it means is that you've got to start thinking and working in where to invest now, so you can benefit from it in the future. Is what I'd read into it. So really, what it goes back to last week saying is it day one or one day, and it's pretty much the same point, but relating more to investing. So
don't you find people who are always studying about property never get into property? They're always studying. Is it not really a practical thing to get into when you get your feet into buying a property? Don't you really have to get your teeth into it and get your feet under the table and actually learn by experience in property? Is it easy to work out?
I would agree with that. I think there's a place for everything. So when you're starting off, you need to actually be a bit techie and geeky and do your research and understand what you're doing. And you got to build the right team around you, people actually you can trust, who understand what they're doing, and you got to see everything practically. And I think once you're clear about your model, you're 100% clear about it, then you can roll it out. And that's when you're right. That's at the point I would say, you should actually then go for it. And then you need to be, all guns blazing. You can't afford to actually let anything slip, because it's like a project. So you've got to source the right property. You've got to do your risk assessment. You've got to make sure the numbers work. So there's a lot more to it than meets the eye. It's often been made to look quite easy by a lot of property professionals, but I never actually say that it's easy. Actually, if I've noticed, I actually say that you really got to do your homework, and you got to have the right people around you who know what they're doing to support you through the exercise. So the advantage we've got is that we are a one-stop shop, so we can help people in optimizing their ability to go out and be successful in property. So I'm pretty confident about that. Yeah.
Excellent. Okay. So where do you think the property market will be next year then, Lakhi Singh? Next March, April, new financial year. Where is property going to be? Are we going to be in a new vibrant economy? Will the market sustain itself? How much of an impact will Brexit have on the property market in the UK?
Okay, so there's probably an unexpected answer from me in terms of what I would say about this. So the unexpected answer is, this is the opportunity of a lifetime. So let me repeat that. This is an opportunity of a lifetime. Now, why do I say that? It's because if you've realized what's going on in the markets, you're ahead of the game, you realize that this is a geopolitical game going on internationally. You know that Brexit is a bit of a joke, really, to actually let out all the bad news. So if you're turning your business head on and you want to turn a profit, if you can read what's happening in the markets, you do all the things that we've just said earlier, and you scale up, you could be the next the big cheese in London and be buying all the properties out. So a lot of it is
like
just confidence.
Parmesan?
Right?
Like Parmesan, you mean? Smell of vomit? What?
Yeah, it could actually smell like vomit, but you may pick up a lot of assets. So you could be big cheese in terms of like the big Cajonas, the big Rockefeller, the big Mr. Paching Ching or Mrs. Paching Ching. Yeah. So the opportunity is there. That's the unexpected answer. The expected answer is yeah, there is a crash, there is doom and gloom. Things are going to happen that nobody's really expecting because people are being furloughed. There's going to be an overspill of, the sort of government running out of money, actually, which are like freebies they've been giving out through business loans. A lot of it's not sustainable. So the overspill of that means that there's going to be doom and gloom for the majority of the UK population. Now, that's not anybody's fault. That's actually Brexit, that's the pandemic, that's global geopolitics. And the lockdown the second lockdown is now further exacerbating that problem. So by June next year, I'd probably say between June and December of next year, you probably see the biggest crash in property, I would say probably in the last 100 years.
All right. So, okay. You go.
So with the crash of that sort of size, it's going to be catastrophic if you're not thinking ahead. Now, I want all of you to realize out there that because I'm talking to not only startup people or mid-tier people or high-net people, I also talk to ultra-high net people. So anybody who's actually worth more than 2 or 3 billion in this market, guess what? Do you know how much property they own in London about 2 or 3 years ago?
About 10 properties.
No, I think the majority of people stopped investing into London altogether about 2 or 3 years ago. So anybody that's worth more than 100 million, I'm talking about, they put their money into a lot of international investments or holding back. And so nobody over 100 million is actually invested into London because they knew because of Brexit. I'm not sure whether they knew about COVID-19, but because of Brexit and the international financial climate, that London was a no-no. So you're still getting money coming in, but it's more the smaller investors. The smaller investors, I mean the 40, 15 million pound investors who are probably not as savvy as the billionaires because they're a bit of a tight club and they all stick together and they look after each other. So they got a lot of money to protect and they will look after each other. So if you can understand what they're doing, and you're starting up, actually, it's the complete opposite. If you can just understand the psychology, what's going on, whenever they come back into the market and start buying is when it's going to be the right time to buy, because that they'll be calling the bottom of the market in the UK. But they'll be probably looking to pick up prized assets like hotels, like probably the best hotels in London. So that's what's going to be happening with them. So I would say to sort of conclude on this, because we're coming up to the end of time, the reality is that if you organize yourself, plan effectively now, build up the right teams. If you're mid-tier type investors, you've got 5-10 properties you've already got going about 2-3 years ago, and if you structure yourself correctly now, your model is the perfect, rides a perfect storm. In June, July next year, you could be adding on another 10-20 assets. But if the market's got the market's got no money, and you haven't structured yourself to get a bridge or finances to be able to purchase, or you haven't got the cash sitting there in your bank account to be able to purchase, then that's the wrong strategy. So anyway,
if you want to end up becoming successful, smelling of parmesan, stinking of vomit, and being a large property owner, smelling of vomit, Lakhi Singh predicts next year, June. Be looking out for that time to invest in property and become part of the elite vomit club. Take care, Lakhi Singh. Speak to you tomorrow, 8 a.m. to 9 a.m. I think we've got a guest in tomorrow who will be joining us. I don't know who they are. I'll find out in the morning. I'll speak to
Deborah Sophia.
That's right. Deborah, that's it. Deborah Sophia.